So we can move now to David's presentation on Israel, and then we will come back to Q&A.
Okay, good afternoon. So during the day we spoke about a lot about risk management and fiscal risks. I think that after the drill fire, at least we can check the box of drill fire risks. So this is something that we all drilled out, just sitting on the chairs. So thank you very much for having me. Following my colleagues, I will briefly present our approach for choosing between US dollar bond and euro bonds in the international markets. And in addition, we will speak a little bit about challenges and also opportunities that existed in the market due to the market condition, and particularly because of the decoupling of the global monetary policy. The other side. Okay. So the discussion topics: short debt overview, which I will get back to it, so you need to listen. Distribution between local and foreign currency, and the composition of foreign currency. So, debt to GDP ratio is 63.9%. The lower chart shows the trends in recent years. Since 2010, we were able to decrease the ratio by more than 7%, mainly due to relative low deficit and high growth. If we compare it to developed countries, we see that the ratio is lower than many developed countries. For instance, the ratio for the Eurozone is 93%. However, it is still higher than our peer groups countries, which is 47%. Although the gap is consistently decreasing since the 2007-2008 global financial crisis. Our average time to maturity is 7.4 years. It has been increased dramatically in the last 2 years, and it's higher than our peer groups. The rollover ratio, which measures the refinancing risk for the next years, basically the short-term debt divided by the total debt, is 10.6%, and is very similar to our peer groups. Our rating is A+ at S&P, A1 at Moody's, and A at Fitch, which just recently revised our outlook from stable to positive. So, the upper chart shows the distribution between local and foreign currency since 1996. As we can see, the foreign currency debt reduced from 25% to 14% currently. However, we maintain to remain with foreign currency debt, not particularly for financial needs, but more for supporting our strategic target, as we will see in the upcoming slides. The lower chart shows the composition of the debt by risk exposure. If we go back to 1996, we can see that 25% from the debt is foreign currency, 68% is CPI linked, local bonds CPI linked, 3% is floating rate note, and 3% is local bond linked to the US dollar. So it is not difficult to see that this composition is not favorable and highly exposed to risk metrics, to risk markets. I'm guessing that the head of the risk management department in 1996 was even lesser than me. Since we were able to reduce the CPI link from 68 to 51% and increase the nominal fixed rate to 30%. However, the CPI link is still high, mainly for 2 reasons. First, according to the law, we have to issue CPI-linked bonds to pension fund and insurance company, which are non-tradable and with very high coupon of 4.86 and 5.56% CPI linked. And second, we issue tradable local bonds for creating benchmark for corporate issuances and also for financial pricing, mortgages pricing, inflation forecast, etc. So, our debt management framework. So basically, the main principle is very, very simple. We differentiate between the issuance policy and the risk management policy. We start by implementing cost risk analysis and quantitative indicators. Using those analyses, we separate between local currency and foreign currency. The local currency is divided to 3 segments: nominal fixed rate, CPI linked, and floating rate. Next, based on qualitative analysis and sovereign consideration, which we call them also strategic targets, we separate the foreign currency to euro and US dollars. And finally, using our risk management policy, we compose the optimal composition of the debt as much as we call to something optimized, but due to model risk and model error and a lot of limitation, we receive guidelines for the optimal composition. So, cost risk analysis. The input for the models are fiscal economic scenarios and also market scenarios based on a stochastic model. We use Monte Carlo simulation, which is good as all other stochastic models. We measure the cost of each strategy issuance by the average annual interest payment, including inflation. We add the inflation because almost 50% from the debt is CPI linked. And we measure the risk using several indicators, for instance, the volatility in the average annual interest payment, tail, expected shortfall, etc. First of all, because it's important to measure the risks on several indicators, and second, it looks nice on the chart, so do it also. I think that the cost risk analysis is a powerful tool to rank between different strategies. But using simple quantified indicators may have a lot of added value. So we look on several indicators such as ATM, rollover ratio, so that it also was mentioned in the other presentation, because it helps, first of all, to explain to decision maker what is the risk. It helps to identify changes in risk between years, and also for comparable with our peer groups, because we can see how relative we are riskier compared to our peer groups. So this is additional analysis that is kind of simple, not such sophisticated, but may have a lot of added value. So, what are the main considerations for choosing between US dollar and euro bond? And some of those have been mentioned in the previous presentation. So, of course, first of all is the market condition, the ability to have access to certain market. For instance, in 2008, we were not able to issue in the global market due to the global financial crisis, so we didn't issue internationally. And second, expanding the investor base may deviate the issuance policy from one market to second market. By the way, we issue our latest international issuance once in the US market. We issue a new 10 years bond for a new bond for 10 years, $1 billion. And we tapped our 30 years bond, which now is in 27. And recently, we tapped again this 30 years bond because of highly of demand from investors from the Foreign East on private placement. Third is maintaining liquid foreign benchmark for corporate issuances. In order for Israeli companies to issue abroad, we issue a benchmark for them both in US dollar and in euro, although most of the financing is in the US dollar market, less in the euro. And the last, exposure of the foreign investor to Israeli markets. Sometimes we see that foreign investor, when they are buying your government bonds, it's not just buying your bonds, they read in the prospectus, they get familiar with the economic, and sometimes it may lead to real asset investments in the economy. So this is also additional targets that we are aiming. So main challenges, first and the most important, and also has been mentioned to all the day, this is maintaining the resilience in times of crisis. That's why our issuance policy is highly relies on deep domestic market. 85% from our issuance policy is in domestic market through all the various segments that we have, CPI, FRN, and fixed rate. Second, according to the law, we issue designated bond for pension fund and insurance company. This is limitation for us because instead of issuing a liquid bond, we have to issue non-tradable bond. But this is something that we have to do according to the law. And of course, maintaining liquid bond both locally, and we are supporting two curves, CPI linked and nominal, and globally the US dollar and euro. This is also not such easy task to maintain liquid bond curve when we issue once in a year. So. Risk exposure policy. So basically the main financial risks are we finance from the highest to the lowest, refinancing risk, liquidity risk, market risk, and credit risk. Under the context of this session, we concentrate on the market risk and a little bit on the credit risk. The market risk drivers are interest rate, inflation, and FX fluctuation, while the risk metrics is the influence both on the debt portfolio and the interest expenditure. We analyze this very closely, the interest expenditure, because this is part of our expenditure law. So we track it very close. Mitigating market risk. So several principles. First of all, we set up a minimum strategic edge using active tools because we don't have natural edge for the US dollar, which is the main exposure. We hedge this strategic amount regardless the cost, regardless the spot rate, the forward rate, and this is something that is according to the risk appetite. Of course, while market condition becomes favorable, we increases the hedge program. Our hedge program composed from two segments. First of all, short-term hedge using FX forward transactions, and second, long-term hedge using cross-currency swaps. And finally, we try to be consistent as much as possible with our hedging program, although we may accelerate the hedging program if the market conditions are favorable. And this is something that we have in those days that the FX forward points are negative because the shekel interest rate are lower than the US interest rate, which is kind of a puzzle, but it allows us to hedge the exposure lower than the spot rate, so why not? Main challenges, first of all, is the depth of the derivative market. We saw that the liquidity, particularly for cross-currency swap for longer maturity, more than 10 years, is not so high. That's why we cannot come in one day and just hedge $1 billion US dollar. We do it consistently and during a significant period. And second is the decoupling of global monetary policy, which we will see in the upcoming slide. This is a challenge, but I also think there is an opportunity here, and I will show it in a second. Okay, so the upper chart shows the composition of the foreign currency debt. Without hedging, this is the blue bars, and with hedging, this is the yellows. As shown in the chart, we were able to decrease the exposure to the US dollar by 11% by using FX foreign transaction and cross-currency swap from US dollar to shekel, and to diversify the risk by 2% by doing cross-currency swap from US dollar to euro. What you are seeing now, it's after a lot of transaction we deemed, so it looks smaller. Of course, that mitigating market risk may increase the credit risk. Therefore, we signed on this agreement with our counterparties, and the threshold is 0, and we transfer on a weekly basis collaterals to reduce the counterparty risk. The lower chart just shows the mark-to-market. So, I think this is the main important slide, although I'm biased because I made it. So this table shows the indication for issuing a US dollar bond and euro bond for 10 years. For a small country in the Middle East, with debt to GDP ratio of 63.9 and ATM of 70.4. The US dollar coupon is 2.6%, which is the treasury plus a spread, while the euro coupon is only 1.1%, which is mid-swap plus a spread. The spread includes new issuance premium. So basically issuing euro is cheaper. In addition, market expectations about increases of the Fed rate. Last time I checked, it was 17% in November and 70% in December for increase. Should appreciate the US dollar and therefore depreciate the euro. Therefore, issuing a euro bond is cheaper and also with expectation of depreciating, which is good for the issuer. Of course, it's good for a country that the euro is not their base currency. Although, as we know, the recipe for unhappiness is missed expectations. So expectations are very difficult to understand. The lower table shows back of the envelope calculation for swapping US dollar to euro and vice versa using cross-currency swap. Basically, cross-currency swap composed from 3 transactions. First, we swap the US dollar fixed rate to US dollar floating rate using USD IRS. Second, we swap the US dollar floating rate to euro floating rate using cross-currency basis swap. And last, we swap the euro floating rate to euro fixed rate using euro. Cross-currency swap is only 2 IRS transactions and 1 basis swap. I think that you mentioned that you were doing it to eliminate the exposure, to diversify the exposure. So the left table shows the calculation. If we see the calculation, we issue a bond, US dollar bond with coupon of 2.6. We will add the euro swap 0.3, subtract the USD swap 1.45. We will add a negative basis, and we receive a euro coupon of 0.95. That means that we can issue US dollar bond, swap it to euro using cross-currency swap, and we will receive lower cost than issuing directly in the euro bond market. If we'll do the opposite, we issue in euro and we'll swap it to US dollar, we'll receive a coupon of 2.75, which is higher than issuing directly in the US dollar market. So why does it happen? Also, some of the charts, I saw that in the other presentation. So the upper left chart showed the US dollar swap rate and the euro swap rate. The euro swap rate is in bright yellow. As we can see, since mid-2012, the euro swap became lower than the US dollar swap rate. It is highly correlated with the monetary policy, the decoupling the monetary policy of the Fed rate and the ECB, as shown in the lower chart. The ECB deposit rates just became negative, while the interest Fed rate remained stable. And in addition, of course, the negative basis swap, which increases, particularly in the last year, increases the incentive to swap US dollar to euro. And finally, the lower white chart show the synthetic spread, which is, as we mentioned, 2 IRS plus a basis. And as we can see currently, swapping US dollar to euro is very favorable. So to summarize, I think that the decision between issuing US dollar bond and euro bond, at least from our experience, is basically to maintain the strategic target and less for pure finance, such as creating liquid benchmark, expose this Israeli market to foreign investor, etc. But there is more to it than just looking on the spread and choosing the lower spread. Using sophisticated tools such as cross-currency swap, we were able to meet our targets, lower the cost, and also mitigating the risks. So thank you very much.
Thank you, David. I think we are doing excellent in terms of the timing. And